The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
And welcome to Volatility Views, your weekly source for all things volatility. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I am joined today on the old Vol Views panel by our stalwart companion, our regular contributor, none other than our volatility pit reporter, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, how is your volatility week shaping up so far?
Oh, the view from here is good, my friend. The view from here is good.
That's all we care about on this show is the volatility views. So I'm glad to hear that the views are good. Of course, we will also be joined a little bit later on the show by good old Bob Kraus from VolX, as well as our special guest in the Volatility Viewpoint segment, Peter Christoffersen. He is the professor of finance over at the Rotman School of Management, as well as the author of numerous tomes on financial risk management, and also many studies on dynamic volatility and how that impacts proper financial risk management, and also some very interesting studies on skew. But we'll get to all of that in the Volatility Viewpoint segment. But now we're going to dive right into our Volatility Review segment.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of action in volatility. And since we're recording on a Monday, a day late this week, we actually get a week and a day. So we have an extra long frame of reference for volatility this week. And so we'll kick it off as we are wont to do with the land of S&P vol, aka the VIX. Of course, that distinction is becoming a little bit more dubious these days with the flurry of ETPs floating around the VIX landscape. But nonetheless, a lot of action in VIX world, a lot of it coming off that sell-off last week, and some very interesting corresponding developments we saw in the VIX and the VIX skew. So, Mr. Sebas, what were you watching last week from a VIX perspective, sir?
Well, it was actually one of the more interesting weeks we've had in VIX. We had on Monday a massive overreaction to the market popping, and we saw volatility in every single derivative product get completely oversold. It was interesting. We had the VIX at 14.8 on the first day. That the S&P should have actually read a higher volatility than 14.8. It was very funny. Well, I think we quickly learned our lesson because Tuesday, Wednesday, Thursday, Wednesday especially, we saw a great pop in volatility, and you could actually almost tell it was over on Thursday because the market was lower, but VIX and the VIX futures all failed to reach levels that they had reached on Wednesday. So now we're right back to a market where, we're at 15 and a quarter, vol's in today, and market's up. And there's not a lot of signs that are pointing toward a major sell-off here. The skew remains kind of steep, which can be bullish. VIX futures are high. You name it. Everything kind of looks it looks a little rosy here today.
VIX futures are high. That's kind of like saying the sky is blue these days in the market.
Yeah, no kidding.
VIX futures when they're
Contango,
low,
which is a good thing.
exactly. When contango goes away, then we can discuss some crazy breaking news in the VIX futures market. Yeah, but that is just the daily price of doing business. Seems like these days in the VIX futures realm is just dealing with that term structure, and it's come in a little bit of late, but still it is an interesting phenomenon to watch unfold over time as just people debate the various causes for that steepness and who's actually buying all of that far off vol and who's driving it up, and the different culprits that are bandied about for that. Is an interesting debate to say the least. But Mr. Sebas, I know you are typically watching the land of S&P 500 volatility, aka the VIX, but we also like to discuss the realm of NASDAQ vol, particularly with the upcoming NASDAQ vol contracts that the boys over at Volex are feverishly working to put out. So have you had a chance to watch the vol landscape of NASDAQ as well over the past week?
Yeah, well, the interesting thing with NASDAQ right now is that it is so Apple driven, and Apple has been just kind of on a little bit of, it's been slowing down slightly, not as much today, but we saw vol come in, we've seen everything. I've been calling NASDAQ the most overpriced options out of any of the major indexes, and that continues to be the case. So I'll be really interested to see whether that can keep up. Apple has just been nuts. It sold off below 600 last week, and now it's back at 615. So that's the one driver is I think NDX vol is by far the most expensive. If you're looking to buy premium, you'd do it in Russell. That's where I would do it.
Yeah, that expensive premium there in NASDAQ and in particularly Apple land is definitely coming home to roost. I know, talking to a lot of market makers these days, all the guys who flocked into corn last year are now starting to migrate back into Apple land. It seems to be the hot product with some vol, with some day trading, with some liquidity across the term structure that you can come trade into and out of. So last year apparently was the year of corn from a liquidity perspective, and this year apparently Apple is the name to beat. Yeah, I still think the boys over at Volex should just call their new product just Apple Plus. I think from a branding perspective, huge. It'd be enormous.
I had a year of corn last year.
Yeah, let's not even go into
really regular.
Let's not even go into the impact of the. See, you went there. I knew you were going to go there. I was worried, and sure enough, my fears came to pass. And
I could have gone there a lot worse, though.
Yes, you did. In your defense, that is a relative level of restraint for you.
And let me tell you, talking corn will help you go for sure. It'll definitely help you go there.
All right. All right, thank you for that, Mr. Sebastian of Slinky.com fame, a.k.a. OptionPit.com. And that's going to do it for our volatility review for this past week and a day. Now we're going to dive into a very interesting discussion with Professor Peter Christoffersen from the University of Toronto's Rotman School of Management.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that festive music means it's time once again for the Volatility Viewpoint segment. And once again here on the Volatility Views panel, we are joined by an outstanding guest. Today's guest is Peter Christoffersen. He is the professor of finance at the Rotman School of Management up there at the University of Toronto. He is also the author of Elements of Financial Risk Management, both editions, as well as the upcoming Handbook of Economic Forecasting. Peter, welcome to the program.
Thank you very much. It's a pleasure to be with you.
Now, Peter, it's interesting that you've chosen such a specific area of research, primarily options and options volatility. How did a former economist for the International Monetary Fund find his way into this very specific area of research?
Yeah, so I was doing my PhD at the University of Pennsylvania in the first half of the 90s. And basically around that time, the first papers had gotten published on modeling volatility, volatility dynamics, volatility risk, and so on. But I think it's fair to say at that point it was still very much there were lots of issues that hadn't been explored in terms of, what are the implications for financial decision making of the fact that now we all of a sudden have to account for the fact that volatility is changing over time. It's partly predictable, but it's partly risky. What implications does that have for example, value at risk calculations, for option valuation, option hedging? And so that's what I spent the last 10 years working on those kinds of issues, and more recently have gotten into looking more at the implications for equity portfolio management.
And now, Peter, much of your research, as you said, focuses on that dynamic volatility, or as we tend to refer to it here, the vol of vol in layman's terms, and how that impacts financial decision making going forward. So, most of us back in our old Econ 101 and our finance courses were taught that the Sharpe ratio, that was the ideal way to measure your risk-adjusted returns. But your research and a lot of your findings are starting to say that if you're an active asset manager or an investor and you want to achieve some sort of optimal portfolio allocation, you actually need to look past the Sharpe ratio and actually start accounting for that dynamic level of volatility. So let's start there then. I think we'll start off with you explaining what you mean by that, and then how, let's say, your active asset manager today or institutional investor should really be looking at and incorporating dynamic vol when he's constructing a portfolio.
Right. So we can actually still talk about that from the perspective of a Sharpe ratio. I think it's fair to say that in traditional portfolio construction, a lot of attention was given to if you want to maximize the Sharpe ratio, you can maximize the numerator, which is the average return net of funding cost, or you can try to minimize the volatility in the denominator, or hopefully do both. Some sort of a combination of the two. But it was sort of viewed in static terms. If you don't think of the mean as being time varying, or if you don't think of the volatility as being dynamic, then really, you're just worried about looking across equities to maximize that ratio. Once you start taking into account that volatility is time varying, then there's a whole other dimension now that plays into maximizing the Sharpe ratio, because now it is apparent that even if you cannot forecast the mean return over time, and we know that's very difficult, then it's still the case that you can maximize or optimize dynamically the Sharpe ratio, because we know that there's a lot of evidence that you can actually forecast the dynamic volatility in the denominator. So in other words, you can maximize the Sharpe ratio by engaging in volatility timing.
That's a much higher level of nuance, I think, than a lot of people who first start looking at the Sharpe ratio are typically prepared to endeavor in or engage in.
Yeah, just a little. I don't think a lot of people using Sharpe ratios are like, oh, I'm going to do volatility timing, which is kind of how would you pose a great question is, and show, hey, this is something that should be done, but most of the regular world doesn't know how to do it. So, what is your response to, how can you practically do what you're, suggesting here?
Yeah, no, that's a good point. So, yeah, absolutely. That's the next obvious question is, how do you do it? So the academic literature has looked at several different ways of doing it. One way is to look at what we call time series models. So try to predict future volatility from past patterns in returns on the assets that you're looking at, and that has that can be done with a reasonably high degree of success. Certainly at the monthly horizon. There's also evidence that you can do it at longer horizons, maybe quarterly, maybe up to a year. There's some degree of forecastability of volatility of each asset. And recently, that literature has done a lot of work on drawing attention to the fact that high frequency information is very useful for forecasting volatility, even if your horizon, let's say, is a month for portfolio rebalancing. There's a lot of information in, let's say, 5-minute intraday returns that you can use to construct very good daily volatility measures that can then be used to forecast daily, weekly, and monthly volatility. So that's sort of one way that the academic literature has come up with ways to help investors with volatility timing. So simply using historical return and volatility patterns to forecast future volatility.
So Peter, so let me expound on that a little bit. So is it really just kind of looking out and trying to find the mean, volatility's mean reverting. So basically, if we are above the mean, that your forecast for a month out is really that it's going to go down. And, if we're lower than the mean, that the forecast is going to go up. And is it sort of that simple, or is it, are you taking into account many more factors like autocorrelation and jumps and things like that?
Yeah, there's lots of ways there's lots of bells and whistles that you can add, but at the most simple models incorporate the feature that you just mentioned, that basically there's reversion to the mean. Now that might seem like a very trivial kind of dynamic, but actually for volatility forecasting, it's not so trivial at all. Because what's really interesting about volatility is it's not something that we directly see. So when you forecast volatility, you actually have to first make an estimate of what is volatility today. And that's very different from, for example, if you think about forecasting the price of a stock, you don't have to first figure out what is the price now. Well, you do, but that'll be on your screen, and so you can very easily find that out. You don't have to estimate the price. The current price is observable. That's not the case with volatility, right? We actually have to go and estimate what is volatility now. So the upshot is that the better methods we have for figuring out what volatility is right now, the better we're going to be able at also forecasting it going forward. Even if the dynamics of from now to a month from now is just a very simple mean reversion like you described, implementing that requires some more care because we need the best possible estimate of where are we now.
So, Bob, it sounds like all these asset managers should get familiar with your favorite tool and Don's favorite tool, the volatility cone. Sounds like that could come in handy.
The volatility cone. You gotta love it. Yeah, and here's kind of a follow-up question to that. I love the concept of mean reversion. I always tell people if we don't believe in mean reversion of volatility, trading options would be impossible. But how do you approach the fact that while something like, let's say, realized volatility in the NDX, the long-term realized vol might be 18%, but probably the instances of readings well below the mean far outweighs the readings above the mean, but it's just that huge moves up kind of throw off the entire predictive volatility forecasts, if that makes sense. That's actually one of the problems people really have that try to mean revert all the time is that, the market will mean revert, but it doesn't do it in a way where it's like, oh, it's a little under and then it rallies back. It's, it's under. Right. It's mean for months or years, and then it explodes up. How do you deal with that situation and that problem?
Yeah, no, absolutely. I mean, so we've known for a long time that volatility dynamics seem to have what we call long memory dynamics. So what that just simply means is that it takes an awful long time for volatility to mean revert, even if it does, right? So you have to be extremely patient to wait for that mean reversion sometimes, and that can of course be costly. Interestingly, some of the most successful forecasting models recently have, let's say for forecasting volatility 1 month out, have a daily factor, a weekly factor, and a monthly factor. So it's not just sort of a simple mean reversion like we've been discussing so far that seems to be the best way to approach volatility forecasting. There seems to be that there are frequencies corresponding to daily, weekly, and monthly that if you treat those separately in the forecasting model, you'll end up with a better forecast. So that's sort of one response to your point. Another one is current work is also very much trying to figure out economic models for the long run volatility. So it may well be that a simple time series model works well for getting from now to the mean, but to the long run mean. But the long run mean may indeed be something that itself moves around and is driven by economic factors. And that's very much what current academic research is working on, is modeling that relationship. So having long run volatility actually be a function of some underlying economic factors. And once we get a better handle on that, I think the forecasting models that built those in are going to be much more interesting and useful than the simple constant long run volatility models that most people are using right now.
Now, if you Peter, if you hedge your volatility with a volatility swap or variance swap, or maybe even VIX or our new proposed vol contracts. Does that kind of do away with or mitigate this dynamic volatility and sort of make it a constant, so that kind of all the models work again and everything is static again?
Right. No, that's certainly one way to think about it. I mean, I think it's very important that portfolio manager and financial decision makers, our thinking has to change in a way that we think of volatility as a risk factor. So not just a constant that can be high for one asset and low for another asset, but indeed volatility is a risk factor that changes over time. So I like to think of that in the context of just simply option pricing. So, the classic Black-Scholes model, the only thing that moves around is the stock price. But in a more sophisticated option pricing model, for example, Heston's model from '93, volatility moves around as well. And so you now had two risk factors, and the option price is a function of these two risk factors. I think for the purposes of equity portfolio risk management, we have to all start thinking in that direction as well. There's two risk factors. The price can move of the stock, but the volatility can move as well. And both of these things matter for the portfolio construction. And indeed, one of the approaches you can take, like you mentioned, is that you can decide to hedge the risk in that new second factor away to a large extent. You can do that by buying volatility through volatility swaps or volatility futures, or by directly buying straddles on the index, which is going to be less precise. But there are these things that you can do to try to mitigate that second risk factor.
Well, Peter, let's keep going with that point then about diversification, where we were all taught back in our finance courses that you could achieve optimal diversification if you're an equity manager, whatever the case may be, by just diversifying it to 12 different assets. That was all you needed to do. Of course, things have become a little bit more complicated these days. And in particular, you mentioned that incorporating of some sort of volatility instrument if you're an equity manager these days. Do you think if you're, and this is a topic we discuss and debate on this show quite a bit with many of our guests, and I'm very curious to hear your opinion. Do you think it's possible these days, if you're an equity manager, given the broad range of correlation we're seeing across multiple asset classes these days, is it possible to really achieve true diversification anymore without incorporating some sort of volatility instrument as an asset into that portfolio, whether it's, like you said, a variance swap or a realized vol contract or a VIX product or whatever the case may be?
I think that's a good question. So I've done some research recently on international equity portfolio construction. And so we looked at 16 developed countries and 13 emerging countries, going back as far as we could, and we looked at returns at a weekly horizon. And what you see in this kind of a data set is that it's really, really striking how at the country level, so these are just equity indices from each country, at the country level, correlation has just trended up. For developed markets, we have data back to the early 70s. And the correlation increasing trend, it just goes all the way back to then, and whereas it started out that the average correlation was something like, let's say 30% across countries back then, it's now up to above 80%. And
kind of tracks global warming, doesn't it?
Yeah, it tracks whatever's trending up. It'll that'll be a good regressor. No, but it's really, really, when you look at this stuff, it's just really wild how the reality has changed for someone who puts together international equity portfolios, for sure. What we find is that when you look at emerging markets, the correlations are at a much lower level on average across countries, but they're also trending up. So there's some diversification benefits to be had from adding on emerging markets into your portfolio, but it's still what it looks like is still just a matter of time before the diversification benefits are going to be depleted in that space as well. So, and when we start to look at, what is it that's driving these correlations up? And you could come up certainly with all kinds of different good explanations for that. Globalization, trade information passing across countries, liquidity in the markets has gotten better, more synchronized markets across countries, and so on. There's all kinds of good reasons why these correlations might have gone up. But when we try to figure out what explains these correlation increases, the only thing that really has a very, very strong, significant positive correlation with correlation is volatility. So that suggests that, if you want to, if you realize that these increasing correlations is a problem for you in your portfolio allocation, and you want to try to insure yourself against further increases, buying volatility seems to be a good idea there as well. Now, maybe what we need maybe is something like, we need maybe some correlation products to help us hedge that risk as well.
That's interesting discussion as well, the topic of some sort of correlation product. Maybe we can dive into that on a future show, because that would be an interesting topic as well. But of course, everything you just said just confirms things we've been hearing for ages with a number of our guests and talking to various aspects of the financial management, asset management, institutional investor space, that it is practically impossible these days to really achieve that true diversification without some sort of derivative instrument being used to capture volatility and hedge with volatility in that portfolio. Yet it's amazing, in this day and age, there still is so much money flocking into these long-only funds and things like that have no sort of volatility component to them. It's amazing in this day and age, and in 2012 that is still the case. Yet, unfortunately, that is still so. But of course, you've also done research into another topic that we discuss quite a bit on this show, and that is skew. And you found a number of very interesting findings and relationships with skew and its impact on volatility and the underlying pricing as well. And I think one of the more interesting discoveries you've made, I think maybe we can get you to clarify that and discuss it a little bit more in detail right here on the show, is you've discovered, or some of your research you found that a stock's exposure to index skew can clarify or explain what you're looking for in the expected return of a stock. And, we expect that, I think, from the individual skew of a particular underlying. You expect that to inform the economic outlook for that underlying by given the paper flow that is coming into those options. But relating it back to index skew, I think, is a little bit interesting and maybe somewhat confusing for our audience. So maybe let's start there with what you mean by a particular underlying skew and its exposure to index skew, and kind of how you quantified that, and then how you came to those determinations afterwards.
Yeah, so there's an interesting new academic literature that goes back to 2006, where Andrew Ng and Bob Hodrick, along with two co-authors at Columbia University, found that VIX, the famous VIX, is actually looks like it's a very important factor in the equity market. So stocks that have a high sensitivity to changes in the VIX have low returns on average, and vice versa. So stocks with low sensitivity to changes in the VIX have high average return. So you could use that fact to construct a portfolio that goes, long a subset of the stocks in the market that have low sensitivities to VIX, and goes short the other end of the spectrum, and make very nice average returns, at least in sort of this academic laboratory that doesn't really take into account turnover and trading cost and all these nasty things that you have to worry about in practice. So we looked at this research and said to ourselves, well, so stocks seem to be driven partly by the sensitivity to VIX, or at least this, the VIX seems to be an important factor somehow in the market, which is very interesting. And we started wondering, hey, maybe it's not only VIX that's a factor, but maybe also the market skew is a factor. So we started investigating that, and whereas VIX is readily available, you can go and download it from the CBOE website. Skew at the time, at least, was not something. When we started this research, the skew was not something that was so readily available. So we had to go and construct it ourselves using, some of the recent methods that's been proposed in the academic literature. And so we constructed this sort of index skew over time, one number every day, just like you have one number for the VIX. And then we took all the equities available on the NYSE and regressed them one at a time on this market skewness, and looked at these.
Peter, 1 second. Are you talking about the skew being sort of the third moment of the distribution? In other words, actual skewness to the statistical underlying, or the skew exhibited by implied volatilities at different strikes?
Yeah, thanks. I should clarify that. So this was skewness implied from index options, just like VIX is volatility implied by index options. So the same information that goes into constructing the VIX, we use to construct the market skew. But that's an important point. Of course, it is indeed the implied market skew from index options.
Okay.
And then we computed these the exposures of each stock to this market skewness factor, and found that very strong evidence that stocks with high exposure to changes in the market skew had low returns on average, and stocks with low exposure to changes in the market skew had high returns on average. And so there again, you could now put together a portfolio of stocks that were long, let's say long the 10% of stocks with the lowest exposure to the market skew, and short the other end of the spectrum, and you would now make a very handsome return on average with this long short portfolio. Again, of course, it's in an academic study where we don't worry about what are the impacts of your trades, what are the trading costs, what are the how high of a turnover is this portfolio. So at least in theory, this would have been very profitable over the last 10, 15 years.
Don't mock the academic laboratory. I've made some of my finest returns in that academic laboratory.
Exactly. It's a lot easier in practice. I realize that very much.
But that's a very interesting finding, I think, that the stocks returns are correlated to their, I suppose, the inverse of their exposure to the S&P skew. That's something that you wouldn't inherently think of over time.
Yeah, no, I was just saying that's really interesting. That skew has such a major thing. I mean, I guess it does make some sense in that if there is heavy buying of skew and puts, that doesn't necessarily mean that people are confident in the underlying, huh? Is that kind of the what the outcome of this kind of study tells us?
Right. So of course the trick is that the next obvious question is, why is it, right? Our finding is purely an empirical finding that seems to be robust, but we don't have a theory for why this is. So, this is implied market skewness from options. That series has two components. One is, that's how academics think about it, at least. We think of that animal as having two components. One is actual skewness in the index, so physical skewness in the index, which is something that's unfortunately very, very difficult to estimate because skewness is a high moment. There's lots of uncertainty associated with estimating it. And the other element is the price of market skewness risk, right? So skewness might be high because implied option skewness might be high because the actual skewness is high in the index, but it may also just be high because people who sell these options require a high price for providing the insurance that, for example, out of the money put options provide. So when the skewness goes up, meaning gets more negative in the market, it could be because actual skewness has gone up, but it could also just be because the price of skewness has gone up. And in our work, we cannot tell which of these two components of market skewness is driving the impact on equity prices in the cross section. So it could be from the options markets as you were suggesting, or it could also be that it's really the exposure to the physical skewness that we just measure indirectly through options.
Peter, I have a question something I'm still not clear on. So you were talking about the implied volatility skew of, let's say, the S&P 500 as they measure VIX and implied volatilities at different strikes. So, but then you also were saying that, essentially, if I understood this correctly, is that you kind of like if you want to be a hedge fund or you want to invest in a long short portfolio, that you would go long the stocks that have, I guess, low skew or nearly flat or flatter, and you would shun those or possibly short those that have a very steep skew. But then you were talking about the index. So now I'm a little confused. Are you talking about the implied volatility skew for each stock, for Apple, Microsoft, et cetera, et cetera?
No, no, thank you for clarifying that, Bob. No, so what we do is we regress the stock return on the market skew and get out a beta, if you like, from that. We get out a sensitivity of the stock from that. So, but this is just from running regressions of the stock return on the market skew, and then we construct portfolios based on the betas with the index skew that we get. And so this is one thing you can do, right? The other thing you could do is you could do what you just suggested, and that is to actually find the skew of each individual stock by not looking at index options, but instead looking at equity options. And actually, there's a team of researchers, including Jennifer Conrad, Bob Dietmar, and Eric Geisels, that have just written a paper on that's forthcoming in Journal of Finance, where they do exactly that. So we were looking at index options and stock sensitivity to index option skew. They instead look at, well, is there information in the skew of each individual stocks that I can use in putting together a stock portfolio? And they find, yes, there is. So there's information both in stocks sensitivity to market skew, but there's also information in the individual equity option skew for each stock. And that information you can use to construct equity portfolios, again, that pay long-short portfolios that pay a good average return.
Now, Peter, I think we all can wrap our heads around the fact that the individual skew of a particular underlying and the options of a particular underlying somehow inform the economic outlook on that underlying. That makes a certain degree of intuitive sense. But one of the reasons I wanted to bring up the relation to the index skew and your findings of that study, because that is a little bit more far-reaching, let's say, and takes a little bit more, as you said, we're all still trying, I think, here on the show, and it sounds like you are as well, trying to wrap your heads around exactly what those findings mean. But it's very empirically and theoretically interesting to see those results and kind of sit back and think of what that could mean in a broader context for the underlyings.
Yeah, no, I think it really is. I mean, I'm still, we're still working on this and trying to figure out what's driving this stuff around. But I think a really interesting implication of all this stuff is just simply that, in the academic literature, there's been a lot of sort of work that's been very, very sort of negative on the good old CAPM model in terms of, the beta with the market doesn't really explain anything in terms of a stock's future performance. Now, what all these results that are coming out are suggesting that, look, the market actually is, the market index has very important relationships with the individual stock returns. It may just not be a simple regression of stock return on market return that you need to do. You need to instead look at market volatility as measured, for example, by VIX, or market skewness as measured by using sort of put-call ratios that we do in our study.
Well, you might be one of the first defenders of the CAPM model we've had on the show so far. You're right. Like you said, in the academic world, that seems to be the whipping boy of choice these days.
Yeah, exactly. But I think we just need to take a much, much broader look at what that model implies. And regressing stock returns on index returns is always going to be a very, very noisy business. It's just difficult to get those betas estimated correctly, and that could well be part of the problem.
If my colleague Don were on the program, I think he might argue with you a little bit on this point. So, as he believes essentially that option traders are really just reacting to current events. So, as the market goes down, everybody, starts psychologically going crazy, saying, "Oh my God, this could be the big one," and they just start buying up puts and increasing the skew, but not because they can forecast any better or they have a better crystal ball than anybody else. They're kind of reacting to, the most recent events and thinking that this could be the big one, And then when the market's heading up, it's like, phew, we dodged a bullet, everything's okay, and now I don't need put insurance anymore. In my way of thinking, in some ways, you need to buy puts specifically when the market's been rising a lot and premiums are low, and kind of lighten up when you're, on the downside after the puts already sort of worked and provided you some of that protection. But it seems like, the world, works the opposite. And then to kind of infer that there's some kind of, divine crystal ball, information
right,
that the option market is divining on the world may be a stretch.
No, absolutely. So we've known for a long time that option implied volatility does a good job of forecasting future realized volatility, and so that's going to be useful for in certain applications. And you can say the same thing about skewness and so on. Now, of course, the question you're getting at is, well, but is it also really the case that is there any information in current option prices that helps me predict future market returns? Right? That's the crystal ball that you allude to in your question, and that, of course, is that's a great question, and we should never ever expect any crystal ball to work really well. You know, in the academic literature, if you can find a predictor of market returns that gives you the R squared, the famous R squared of 5 to 10%, you'll get published and be hugely famous for that, right? The success criteria for forecasting return is just very, very low. We know it's very difficult. We know there's a huge amount of noise to signal in forecasting market returns. So the point, though, is that any little small piece of information that you can get about future expected returns is likely to be quite valuable. And to my reading, one of the most successful predictors of future market returns, just maybe because it is so difficult overall, one of the most successful predictors these days is actually the variance risk premium. So say the VIX minus realized variance. So something that very much is derived from option prices. It's of course not the case that you have you can explain 95% of the variation in returns. You can maybe explain 5% of the variation in return, but that's actually compared to other predictors, not bad after all, and something that investors will be willing to pay you some fees for achieving.
Yeah, and I would actually, make one argument on kind of, especially the skew argument, is that, I do believe that volatility, the explosions in VIX, things like that, are very reactive. Don and I agree there, but at the same time, the skew curve, in of itself, is not nearly as reactionary, in my opinion, as at the money volatility or VIX. VIX is actually kind of a skew and at the money all in one. But I'd be interested to see what are the where does your kind of skew analysis work better? Is it in is it high correlation to skew in low vol? Is it high correlation to skew in high vol? How those might contribute to some of your predictive efforts, let's just say.
Yeah, so we looked at our data goes from just from 1996 until now, and it tended to work better earlier in that period than later in the period. That's the only sort of strong subsample result that we found. So whether that was, but it's not so obvious that that's related to the level of volatility or anything like that. We didn't find any sort of conditioning on particularly market regimes.
Yeah, well, one of the issues with trying to just look at skew independently is that when we got that sell-off last week, right, and the VIX went from an elevated 14.8 to a booming 17%, we saw skew flatten up. The SIBO skew index or whatever type of measurement you want to use, skew flatten up. Now, did that mean that traders went and sold out of the money puts? No. What happened was at the money volatility increased. All of the the increase that we saw in VIX was coming from at the money options. The straddle itself got oversold. Put prices, actually put vol stayed constant and maybe ticked up slightly. So that's one of the real issues you can have in measuring skew, is that you need to have kind of a point to it. It's one of the reasons like Sabre model is kind of a cool thing to look at, because if you look at all the different kind of sticking points for that, where you're centering that skew off of, I think it makes a major difference on how you would look at data like that. I don't know if that makes a lot of sense to you, but
no, I mean there's lots of interesting issues to study in terms of what's the relationship between volatility and skewness over time. And indeed, you often see examples of the phenomena you saw last week, that when volatility goes up, skew actually flattens. That is not only last week that happened. That has happened in many episodes before. So there's not an obvious positive correlation between the two.
Well, Peter, I think we just scratched the surface of your research today. I think there's a lot more we could spend some time discussing. I know a lot of us here would like to spend many more hours diving into your work on skew and, of course, your upcoming work on implied betas from options and options volatility. But I believe we'll have to save that for another show. But before we go, I'd be remiss if I didn't offer you a chance to plug your upcoming book. So why don't you tease our listeners with an overview of the Handbook of Economic Forecasting, as well as your planned release date when they can get their hands on that book.
So the Handbook of Economic Forecasting is actually edited by two of my colleagues at University of California, San Diego. But I have, along with the two co-authors, Chris Jacobs and Bo Chang, we've co-authored a chapter on using option implied information in economic forecasting. So that's our contribution to that handbook. And certainly anybody who's interested in taking a look at that can send me an email, and I'll be happy to send them the early draft, which we already have ready. And it basically goes through the different kinds of forecast applications where academics have used option implied information to improve their forecast, which, from volatility to skewness to portfolio, up to deciding on portfolio allocation to forecasting jumps and so on.
And of course, if you're interested in Peter's work, you can also go pick up his 2 editions of the Elements of Financial Risk Management. Just search for him on Amazon. It's all available there. Christoffersen, Christoffersen, and Peter Christoffersen. You will find all of that and more. I just did a preliminary cursory search before the show, and I found not only your books, but a plethora of books in which you are cited in some way, shape, or form. So you are heavily represented on Amazon in the financial literature section there, Peter. So ballyhoo to you, I should say. Congratulations. But thanks again for coming on the show. I think we'll definitely have to bring you back on again down the road as we can look into some more of these developments on your research into skew and options, betas, and a number of other topics that we just barely had time to scratch the surface on today.
That would be great. Thanks a lot for having me, guys.
Great. Thank you. All right, and that's going to do it for our Volatility Viewpoint segment, and now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball. This is, of course, a portion of the show where we gaze deep into the murky ether of the future and attempt to divine what the Vol gods hold in store for us. And for this segment, I am joined yet again by one Mark Sebastian from OptionPit.com fame. He's also known widely in many circles as the voice of Cramer, aka the puppet master of Cramer, when it comes to volatility subjects. You are his speechwriter of choice on that subject.
I did not know that. That is good to know.
You are his Toby from The West Wing. You are his speechwriter of choice.
Oh, that's lovely. I thank you for informing me.
You also bear a striking resemblance to that actor, which is very interesting. But listeners, we are, of course, aside from your various speechwriting tasks, we are here to pontificate on the future of volatility, and we'll kick things off, as we always like to do, with S&P 500 volatility, aka the VIX. And as we discussed at the top of the show, that we are still in a slightly lessening but still contango environment for the VIX futures, and we're hovering around, as we're recording this, in the VIX cash about 15.3. So the VIX cash still hovering at that 15 level, despite what we saw last week with that spike in VIX land. But as we discussed at the top of the show, not a lot of indicators to point to any sharp spikes on the near term for VIX, or as well as any sharp sell-offs to the downside. I think we're probably going to hover around here for a while, or perhaps maybe continue to slightly sell off to the downside. Is that your prediction as well, Mr. Sebastian?
For a sell-off, I mean, I like the VIX to kind of stick between 14 and 17, something like that. I think that there's still tailwinds to the market going up, and that's going to naturally lead toward the VIX falling. I don't know if Don's ever told you this, but there's this squaring function on the VIX.
Oh, I have heard. Tell me more of this squaring function.
But no, it's I just think that right now the path of least resistance is up. So that's what you gotta continue to. That's gonna force the VIX down.
Yeah, that appears to be where the headwinds are blowing. And of course, as the market gently sails up, the VIX will correspondingly, at least it's supposed to, gently sail to the downside. And of course, as we head closer to the summer doldrums, one more month till that over-quoted phrase, sell in May and go away. Then who knows what happens to the VIX after that.
Tell me now.
If we're still talking VIX 15.25 in September or October, that could very well be the case, given everything we're seeing.
It could. I mean, you just don't know.
We had some interesting discussion on our last segment with Professor Christoffersen about the time impact of mean reversion in volatility and how it could take quite a while for that mean to revert, and we could be waiting quite a while for VIX to see any substantial movement on that reversion scale.
Exactly. It makes a huge difference. So,
and also in the realm of Apple Plus, aka NASDAQ, are you leaning on the same side of the fence there, that a general sell-off as the market or should I say the market, as Apple continues to rally?
Yeah, I mean, Apple vol is going to have to come in at some point. But, it's in a touch today. So, but the stock's up big. So who knows? Apple, as goes Apple, so goes the NASDAQ. And we may see a little bit of an increase in vol, after Easter. I mean, we're going to Easter. There is no way vol's going to be popping. But after we get back, as we head into earnings season, we may see a small incremental increase in volatility as traders come in and start playing earnings season.
And as you mentioned, Apple up 3% or about 16.5 points today on no apparent news whatsoever.
Nope, it's Apple.
Just the fluctuations of Apple.
It goes up.
It's a Monday. It's Apple. You have to buy it. And
this is America. Apple goes up.
So just amazing. And yet, of course, the vol, you think it would have come off substantially given all the, just the endless uptrend in here. And we saw that around the upper 4 level, upper 400 into the 500 level. We saw a nice sell-off in Apple vol, but it seems to have definitely peaked again, or is peaking as it continues to rally. So an interesting viewpoint there on Apple vol and when or if it will ever come off. The people keep buying it, and yet the vol keeps getting bid up. So it
will go to $1 million.
Yeah,
it's just the way it is.
The first $1 trillion company, of course, you've heard that everywhere, and that's the next benchmark now. Now that it's past 600, is when it will hit $1 trillion. We could do a whole show just on Apple volatility. Maybe that should be our new show on the Options Insider Radio Network. Apple vol. I think there'd be a lot of subscribers for that show. Yeah. Call me crazy. All right. Thank you for that, Mr. Sebastian. That is going to do it for our Crystal Ball segment. That's also going to do it for this episode of Volatility Views. I, of course, want to thank Bob Kraus for joining us on the Volatility Viewpoint segment, as well as our guest, Peter Christoffersen of the University of Toronto Rotman School of Management. You can check out all of his work, as we mentioned, on Amazon, his many books, as well as his research, and we will link to that in the show notes for you. And, of course, last but not least, Mr. Sebastian, thank you for joining us on the show today as well. And what is coming up in the land of Option Pit you'd like to let our listeners know about?
Oh, well, if you go to you can try our Option Pit live service for a penny. Just go to optionpit.com/bull, and you can do a penny for a week, $39 for the rest of the month, and then and if you stick on, we're also going to make a very special offer to some of our other packages as well. So it's absolutely worth checking out. And don't forget to pre-order my book on June 3rd.
Yes, a fantastic book. I had a chance to check it out ahead of time. And listeners, if you're interested in proper risk management and how to implement that across your options trading, then by all means, check out Mark's book. Refreshment on the title, Hedge Fund. What was it?
It's called The Option Traders Hedge Fund.
There we go. Yeah.
By Mark Sebastian and Dennis A. Chen.
A scintillating read, if I do say so myself. And by all means, listeners, Option Pit Live for a week. For a penny. You can't get a better deal than that. By all means, throw Abe Lincoln at Mr. Sebastian and check out all that he has to offer over there. And try not to hit him in the face, because that is his moneymaker these days.
Okay. Yeah. Thank you.
You're welcome. All right. Thank you for that. And that is going to do it for this episode of Vol Views. Of course, we want to thank all of you out there for downloading and streaming and subscribing to the program and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.